Hello, and welcome to revision tips for CIPS Level 3 Advanced Certificate in Procurement and Supply Operations. This is Module 1, Procurement and Supply Operations, Environments, and Learning Outcome 2, which is to understand the pricing arrangements in commercial agreements. Are you aware of the 5 rights? One of the 5 rights is achieving the right price, and therefore deciding on the right commercial agreement is important. Should it be a firm price or not? And what are the risks and benefits of that approach? So pricing schedules are commonly used. They state the price for different quantities purchased and clearly indicate the volume discounts. These are often used in markets where supply and demand dictates the price and the buyer doesn't have much influence over it, and it's used to provide the breakdown of costs as per the tendered bid. Buyers need to have a good understanding of the supply market in order to understand whether supply and demand is in balance, and watch for trends in the market in order to be able to react to them. So, for example, buying larger quantities when the price is lower. Another good reason for using pricing schedules is if you can't dictate or remember or need to know how much you're going to need of something. So it's kind of like a bit like a catalogue, I guess, where you can just pick the volumes that you need depending on the price or the discount being offered at that moment in time. Alternative to that is something known as a fixed price arrangement. And as the term suggests, the price you enter into doesn't change. It's used when the specification is clearly defined in advance, the work is not too complicated, quantities can be estimated with accuracy, and few, if any, changes to the scope or project are expected. The price cannot normally be changed unless the contract allows for an adjustment in the event of a certain outcome. So there are a few types. The firm fixed one is the most common because it details the requirements and the price that are agreed in advance, and the price does not vary. But certain industries like to work with something known as a firm fixed with incentive. So the price paid can vary depending on whether the final cost is above or below the planned cost. And a fixed price with an economic price adjustment is fixed, but can be adjusted for specific changes like the national wage might increase. But whatever fixed price contract you enter into, the supplier will have to think about their direct and indirect costs. The direct costs being the materials and the casual labour that they use, whereas the indirects are your overheads and salaries. Now, both the buyer and supplier quite like fixed price arrangements. So from a buyer's point of view, there's no risk to them if the market increases, but there's a risk to the supplier if it does. But equally, it can go the other way. The buyer doesn't benefit if the cost decreases, but the supplier will. But they're predictable for both the buyer and the supplier. The buyer knows exactly how much it's going to cost them, and the supplier can forecast and deploy their work accordingly. There are some cost plus arrangements as well. These are some alternative ones that you might see. So a cost plus arrangement, what happens is the supplier calculates the cost of the components or the materials and then adds an amount of profit to arrive at the price they quote. Cost reimbursable, the supplier's costs are covered and an agreed amount is paid on top of their profit. Gain share pricing is based on a supplier achieving a level of performance over and above what would be expected in normal conditions, and the buyer and supplier will share the savings. An incentive-based pricing ties the price to the achievement of an agreed level of performance. So let's try and calculate the example on the screen. The material cost of 40,000. Direct labour cost of 4 people working 5 days a week, each earning 350 a day. The overheads of £3,000 and the margin or profit of 30%. So we simply take the 40,000 material costs, For the labour, we need to take the day rate of 350, multiply it by the 5 days to give us 1,750, and then multiply it by the 4 workers to give us £7,000. We have 3,000 of allocated overheads. If you add those together, you come up with £50,000. This is your costs. And then to put your 30% on top, you would need to times that 50,000 by 0.3 to give you £15,000 worth of profit. Add them together, £65,000 is what you would be quoting to your buyer. Now, there are some benefits to cost plus arrangements in that it's quite simple to understand and it's easy to calculate as long as the costs, both direct and indirect, have been taken into account. The supplier is assured that they will make a profit as long as they've done their calculations correctly. But the downside is it's based on historical costs and there's no incentive for the supplier to keep the costs low or to innovate. And it doesn't really account for the competitor who may very well undercut the costs. And cost reimbursable, again, guaranteed profit for the supplier, no risk to them at all, and it's really easy to understand, but it's a big risk to the buyer because you don't know how much it's going to cost until they get on site and have a look at the project. Again, no incentive for them to keep the cost down or complete the work quickly, and again, doesn't account for the competitor who could have undercut the costs. Indexation is used for commodity-based markets like metals and chemicals and fuels, or in markets with cyclical or fluctuating supply and demand. To calculate an index, you need to select a start year. This becomes the base year with a value of 100. Subsequent years are expressed as a percentage of the base year, and this process is called normalizing. Suppliers use index prices to react quickly to changes in the market when they have entered into a commitment without knowing the costs. So let's just assume that this is the cost of fuel and the start year is £1 or $1. So you can see your prices have gone up in year 1 and 2, whereas the index actually went down. But it seems to have sorted itself out in years 3 and 4. It's a really good way of tracking what something should cost rather than what it does cost. Now, another important part to remember when we're talking about, pricing and the commercial side of a contract is to consider the payment terms. And as we discussed earlier, cash flow is a key measure of a business's financial health. Without money coming in at the right time, the business runs the risk of not being able to pay their staff or their suppliers on time. And cash flow is dependent on invoices being paid on time, which means payments must come with terms and conditions. So the terms of sale essentially set out the expectations. You could have payment in advance, immediate payment, or net number of days. You could use a line of credit, interest invoices, a letter of credit, a bill of exchange, or contra. So let me explain the difference between, firstly, let's go payment in advance. This is where you would book something. Say you were booking a holiday. You book today, pay today, but you fly in 6 months' time. Immediate payment, on the other hand, is where maybe you bought something on Amazon and you pay on transaction and the goods are dispatched immediately. The net X days could be 30 days, 60 days, 90 days. Essentially, if you buy something today, you'd need to pay for it in 30 days' time. Now, those net days can either come with interest or discounts. So it may attract interest if you pay on day 32 instead of day 30. But equally, if you pay on day 15, you may be able to get a discount for paying early. The line of credit works like a catalogue. You buy the item, but you spread the payment over a number of months. A letter of credit is a promise to pay that's sent from the buyer to the seller in international transactions. So a letter of credit will go when the goods have been loaded onto the ship. A bill of exchange works a little bit like a post-dated cheque, but I don't know anyone that uses that anymore. And finally, contra trading happens when you have a situation where you buy and sell from the same organisation. So what you can do in this mutual trading example is to deduct what they owe you from what you owe them. So let's talk about open book costing next. This is where a supplier shares information with the buyer about the actual costs incurred in delivering the product or service. The supplier is paid for these costs plus an agreed profit margin. This will promote supplier collaboration with the buyer. And the aim is to reduce the cost for the buyer without decreasing their profit. So what you can see on the screen is the price now and the price in the future. The only ones that really change are the materials and the overhead costs. The labour costs and the profit costs remain exactly the same. So you might ask yourself, why would a supplier do this? So one example I've seen work really well in the past is where you incentivise the supplier to find you, I don't know, £100,000 worth of cost savings every 12 months. And if they are able to achieve that, then they may get their contract extended by another 12 months. So a contract that started out as a year could end up being 5 or 6 years long. But there are 4 stages to implementing open book costing. The first is obviously to sit with the supplier and explore their willingness to be participating in this, to gauge their level of interest. Then test it out in a low risk way, whether or not open book costing will work with the supplier. Scale it up and try and get better benefits by testing it out in more major areas after the testing has worked. And then finally, to embed it, it should become sort of business as usual and a general way of working so that benefits are continuously generated and sustainable. And the final thing to talk about on Learning Outcome 2 is the concept of lean thinking. And lean is a business methodology that aims to create more value with fewer resources. Lean thinking is making a series of incremental adjustments that over time deliver efficiencies. It identifies the maximum value from a customer's viewpoint and eliminates functions that create no value. There are 7 types of waste that were categorized by Tadashi Ono, and they can be eliminated in procurement using lean thinking. Now, I can remember this much easier by remembering the name Tim Wood. The 7 wastes are each one of those letters. So let's start with the T, transport, unnecessary movement of products on the road. I for inventory, holding more than you need. M for motion, double handling things in a warehouse or putting things out of reach when you need them regularly. W for waiting, waiting for approvals, waiting for deliveries. Try to streamline your process so that you spend less time waiting. Overproduction is about producing more than you can physically sell or when they're due. Overprocessing, doing things that don't add value in the eyes of the customer, like putting a pretty bow on top that they just rip off and throw in the bin. And finally, defects. And defects, you need to try and get it right first time because defects waste time or money by either reworking it or throwing it in the bin. And that's the end of Learning Outcome 2. Thanks for watching.